just 23% of Brits have invested in the stock market. It's a similar story in China and even lower in other parts of the world, including France and Germany. And while some people genuinely can't afford to invest, for others, it's a different story. If you're new here, hi, I'm Nischa. I'm a former investment banker turned financial educator. And today I'm breaking down big investing lies that could be keeping you broke and finally telling you the truth. By the end of this video, you'll know firstly why these myths are so unbelievably common. Secondly, how they quietly hold you back from building wealth. And third, the truth and how to rebalance them with beliefs that actually make you money. Myth number 1, investing is just gambling. 55% of Brits are unwilling to invest their savings in the stock market, according to a YouGov poll. And 65% of those who don't invest say it's too risky. And I can see why so many people feel this way, because unless your parents taught you about the stock market or you studied finance, you probably learned about investing from the news or through social media. And when markets crash or crypto prices skyrocket overnight, investing can look a little bit like gambling, like walking into a casino and putting your life savings on black. You stake your money, the numbers go up and down, and if you're lucky, you double it. If not, you lose everything. Not exactly the best first impression. If this fear sounds familiar, here are a few things to keep in mind. First, gambling is based on luck, and the odds are stacked against you. Even if you win early, gambling always has a negative expected return. The house always wins by design. Investing, on the other hand, isn't like that. When you invest, you own real pieces of real businesses, companies that make products, employ people, and generate profits. Over time, those profits drive returns and are passed on to investors in the form of dividends and rising share prices. In fact, over the past century, stocks and bonds have reliably produced positive returns, and the longer you stay invested, the more likely you are to win. Using almost 100 years of data on the US stock market, Schroders found that if you invested for a month, you would have lost money 40% of the time in inflation-adjusted terms. However, if you had invested it for longer, the odds would shift dramatically in your favor. On a 12-month basis, you would have lost money 30% of the time. Over 5 years, that figure falls to 22%, and at 10 years, it drops to 13%. The data also shows that there have been no 20-year periods where large cap US stocks lost money in inflation-adjusted terms. Even more reassuring is that after sharp daily drops, the market often rebounds quickly. In fact, more than a quarter of recoveries happen within days. But you rarely see that headline. The news loves reporting market crashes, not quite recoveries that follow, which makes investing look far riskier than it really is. And this matters because research shows that negative economic news has a stronger emotional impact than positive news. So when we see dramatic downturns splashed across the front pages, but not the rebounds, it reinforces the myth that investing is dangerous. And there's also a psychological element. Studies show that the same part of the brain that lights up during gambling also activate when people trade volatile assets like crypto or options. That's why some investors chase trends, try to time the market, or panic sell when prices fall. It's the same thrill of the chase and the same urge to win back losses when something goes wrong. A long-term investor, on the other hand, does the complete opposite. They diversify, they stay invested, and they focus on building wealth over time rather than hoping to hit the jackpot. And that is what we're going to be talking about on Sunday. Depending on when you're seeing this, it is today. So if you don't know what to invest in, how much to invest, how often to invest, or you're just scared of getting it wrong and losing money, then I have a completely free workshop. We'll walk through the exact system you need to follow to start investing with confidence. It's completely free. It's 45 minutes. And you could sign up at nischa.me/invest. Also linked in the description, that is nischa.me/invest. Myth number 2, I don't know enough to invest. In 2012, the Observer newspaper ran a competition to find out who's best at picking stocks. There were 3 contestants, 3 experienced money managers, secondly, a group of high school kids, and thirdly, a ginger cat called Orlando. Every contender was given an imaginary $5,000 at the start of the year to invest. By the end of the year, the professionals had grown their portfolio to $5,176. The students were down to $4,840, and Orlando had amassed $5,542. He chose his stocks by throwing a toy mouse on a grid of numbers allocated to different companies. So tell me then, why 41% of Brits say they don't invest because they don't understand how the stock market works. Because although the Observer's experiment was more fun than science, it still underlines decades of genuine research that shows experienced investors struggle to beat the market. In fact, in the US, 88.29% of funds underperformed the S&P 500 index over the last 15 years. And that's actually good news for you because it means you don't need to be an expert to get started. You don't need to spend your mornings reading the Financial Times or trying to find the next Nvidia, because that's exactly what index funds are for. They let you invest in hundreds, sometimes thousands of companies all at once. So instead of guessing which ones will do best, you automatically own a tiny piece of all of them. It's a really great way of reducing the risk too, because if one company has a bad year, it won't have that much of an impact on your overall return. And historically, the market as a whole tends to grow over time. So the biggest risk isn't doing it wrong, it's just doing nothing because you're afraid of getting it wrong. So you learn far more by investing a really small amount and just watching how it behaves than by waiting until you know enough. Because no one feels like an expert when they start, and even the professionals don't have it all figured out yet. But you don't need to be an expert to make progress. You just need to start, learn a little as you go, and let time do most of the work. Myth number 3, I don't have enough money to get started. According to a study done by Deloitte Access Economics, more than 1 in 2 people who don't invest said they don't have enough money to get started. 1 in 4 expected to need more than 10,000 before they could finally take the first step to building wealth. It is a really common misconception and one that keeps people on the sideline for years. Because when most of us picture an investor, we imagine someone with this 5-figure portfolio, complex spreadsheets, and insider knowledge. It feels like a club that you can only join once you're already wealthy. But that's never been true, and it's definitely not true today. Thanks to fractional shares and investment apps, you can now start with as little as £1. There's no minimum balance, no gatekeeper, no human that you need to go through like you had to in the olden days, and no need to wait until you're rich. What matters most isn't how much you actually invest, it's how early and how consistently you do it, because compounding rewards time, not wealth. In fact, I'm going to show you the numbers. Someone who invests $50 a month at 25 will likely end up with more than someone who invests $100 a month starting at 35, simply because their money had an extra decade to grow. The biggest mistake people make is waiting until they feel ready. But the truth is, you will never feel ready. There's always going to be another bill. There's always going to be another goal. There's always going to be another reason to delay. The key is to start where you are, even if it's just a few pounds or a few dollars or a few euros. Build the habit first. The numbers will then follow. Every investor that you admire started with something small. The only difference is they didn't wait until they could afford to. They started so they could. Myth number 4, it's too late to start. You've probably heard stories about people who started investing $500 a month in their 20s, got an average annual return of 10%, and retired at 50 with more than $1 million in the bank. But how many people can actually do this in their 20s when we're only just finding our feet in the world? You might still be at uni doing an apprenticeship, or in the early stages of your career, your income is probably quite low. And as the years pass by, the financial obligations do start creeping up. While you're mid to late 20s, you might be trying to get on the property ladder, staying out of credit card debt, or trying to save for a wedding. With so many short-term expenses to budget for, it's only natural to just say, I'm going to push investing to one side and focus on it when I can. And then by the time we reach our 30s or 40s and we look back on how much progress we could have made if we started investing earlier, it's natural to just feel it's too late. You start playing around with an investment calculator and you think, okay, if I started 15 years ago and invested $200 a month and got a return of 10%, I'd have more than 80,000 already. Stop torturing yourself and start looking forward instead of back. Start now with $200 a month and you'll reach the goal in 15 years from now. If you can increase your contributions to $300 a month and get the same return, you'll have more than 120,000. Because chances are by the time you reach your 30s or 40s, your income's probably higher than it was in your first few years of adulthood. And hopefully you're more financially stable and you can afford to invest more each month. And that makes a much bigger difference than you might think. So even if you're starting later, you haven't missed out. The time will pass anyway, so you might as well start now. And whilst we're on this topic, one of the best investments you can make alongside investing in assets is investing in yourself, which brings me to the sponsor of today's video, and that is Brilliant, an online learning platform that I use and love. Brilliant takes complex topics and breaks them down so they actually make sense. You learn by doing, not just reading, with thousands of interactive lessons covering everything from maths to data analysis to programming and AI. One of the best things about Brilliant is how it helps you build learning habits in just a few minutes a day. I'm always saying that consistency beats intensity, And Brilliant makes this easy to stick to. So whether you're waiting for your coffee or you have a few minutes in between meetings, you can squeeze in a quick session and actually make progress. So whether you're a student, working professional, or just someone who loves learning new things, Brilliant has something for you. You can try Brilliant at brilliant.org/Nischa. I've put the link in the description below, or you can scan the QR code on the screen right now. Brilliant's also given our viewers 20% off an annual premium subscription, which gives you unlimited daily access to everything on Brilliant. So, quick recap, what we've covered. Investing isn't gambling, it's owning real pieces of businesses that grow and pay you over time. Second, you don't need thousands to get started. You can begin with whatever you have. Third, you don't need to know everything before you start. You'll learn as you go. Fourth, it's never too late. What matters most is that you start now and stay consistent, even when the market goes up and down and the news makes it seem like it's the end of the world. Because if you haven't started investing yet, these myths might be surprisingly comforting. They give you all the reasons to wait, to put it off, to tell yourself, I'll invest when I earn more, when things calm down. But the truth is, waiting is the most expensive decision you'll ever make. No matter how much you're starting with, just start. Time will pass anyway, so you may as well put your money to work today. Thank you so much for watching. If you know someone who hasn't started investing yet, but has used one of those myths that you've heard today as an excuse, don't forget to share this video with them, and don't forget to subscribe if you haven't already. Otherwise, I'll see you in the next one.